A very good morning, traders. I am Himali Bhatia from the Financial Analyst, and I welcome you to the Bold Project. In this module, we will be discussing about the Dow theory and its application in the practical markets. Now, why is this theory very important to us? Because this creates a trading discipline which is a must for a trader. So, what are we trying to achieve from Dow theory, if you ask? We are trying to hit three birds with a stone over here. The first, we will try to understand the market psychology. Second, we will be talking about a few aspects on the money management. And the third, we will be trying to build a watch list basis the principles given in this theory. Now, let's start with what Dow theory is and how it is important to us. So, Dow theory was named after Charles Dow, and he is considered to be the father of the technical analysis. Now, the beauty of this theory is that it has been in existence for over 100 years, but it is still the foundation of the technical analysis. And on the other hand, the surprising part is that Charles Dow himself never published any book, nor did he publish the full theory. So basically, it was his admirers who captured his ideologies and have put it in a pen and paper form. So this shows the importance of what Dow theory is and how it will build a characteristic for us traders to trade in the markets. Let's talk about the first principle. The first principle says that the stock market discounts all information. Now, what does that mean? Let's put it in a layman's language. Let's say that tomorrow you have an exam. So, what will you be doing today? Today, what a person ideally will be doing is he will be revising for the tomorrow's paper, right? And during his revision, what he will be doing is he will be trying to place a lot of focus on those chapters which he thinks are important or has a higher probability of coming in your tomorrow's paper. So, what his behavior is, he is trying to predict the outcome of the paper, and basis that, he is doing his preparations beforehand. So, a similar sort of a behavior is witnessed in the stock markets as well. So, what does that mean? Let me give you an example over here. Let's say that there is some information in the market that the next week RBI will be conducting a meeting. All right. Now, what the stock market participants will do is they will beforehand, even before the event has occurred, they will discount the information and they will predict what the outcome of this meeting will be, and basis that they will drive the prices in a given direction. So if they feel that the outcome of this meeting will be something which is positive for the stock markets or the economy in general, what they will do is they will drive the prices higher even before the event has occurred or even before this meeting has occurred. And on the other hand, if they feel that the outcome of this meeting will be something which is not positive, or rather something which is not too effective for the economy, what the market participants will do is they will start driving the prices down even before the meeting has occurred. Let me give you one more example over here. We all know what happens during the results period, right? Now, even before the company posts its results, what the market does is they beforehand drive the prices either up or down depending on what they feel like or what they think the company will be posting its result. So, if they feel that the companies will be posting the good result, they will be driving the price up beforehand. And if they feel that the company will be posting a poor result, they will be driving the prices on the downside. Now, over here, let's try to understand and place a little bit of more emphasis on what does discounting of information mean. Now, discounting of information does not mean selling the stock. That is a big misconception that the traders have. Discounting of information means taking into account a given piece of information and acting upon it. All right. Now, what sorts of information are we talking about over here? Any piece of information that directly or indirectly affects the stock market is getting discounted by the market participants. So, what sorts of information that could be? It could be any information ranging from your macroeconomic level news, from your microeconomic level news, to your political news, to your maybe central bank related news, to your interest rates news, or even maybe the results. Any piece of information that affects the market will get discounted, except for one particular piece of information, and that piece of information is nothing but your natural calamities. Now, why does natural calamities does not get discounted beforehand? We will be talking about that in a few minutes. But before that, let me give you a few live examples of how market discounts information beforehand. So over here, I have already picked out one article which we had posted on our Instagram page, which is at the financial analyst. So over here, the news says that a couple of stocks, Indian stocks, were added in the MSCI index. That is nothing but your Morgan Stanley Capital International Index, and it is related to your emerging markets. So, one particular company known as Balkrishna Industries, this had also been added in the index, and this news was out, I think, on the 13th of November. Now, let's look at the chart and see what has happened. On the chart, on the 13th of November, the prices were already at a high. All right. Now, what has happened beforehand? The markets beforehand started discounting this information and they started driving the prices up. So we can see that from the 3rd of November, the prices started moving on the upper side, and thus the markets beforehand discounted this information and did not wait for what the outcome will be. Now, how does this happen? Is this insider news or is this insider trading? No, this is not considered as insider trading. Rather, the case over here is that, markets generally try to trap retail traders, and retail traders do not have access to such information beforehand. This information is already publicly available to the big entities, to the FIIs, to the DIIs. So what they do is they start driving or they start buying the prices or the stock at its lower levels, and from there the prices start moving up. And once the information is out, the retail traders, tend to long the stock in this case, and what happens is they get trapped over there. All right, let me give you one more example. Uh, let's talk about one example of IRCTC. Now, over here it says that for its quarter two, standalone net profit was around 326 million rupees versus a profit of 998 million year on year basis. Now, of course, if you compare it on year basis, IRCTC did not show a much good profit. However, compared to its street estimate that was of a net loss of about 104 million, it posted really good profit. So let's look at the chart what has happened earlier. On IRCTC, we can see that E stands for earning, and the earnings were out on the 12th of November. Now, even before the earnings were out, what has happened is the market started pushing the prices on the upside. And what has happened is the retail traders, they must have got access to this information on the 12th of November. They must have gone long over here. And after that, the market is currently now in a consolidated state. And what could potentially happen is the markets could start falling down from here. There could be some sort of a profit booking. And thereby, the retail traders tend to get trapped over here. Thus, we say that the market discounts all information, and the retail trader should never and never trade on the news. I'm not saying that the news based trading is something which is not profitable. It is, of course, on certain occasions, it is profitable, but on majority of the occasions, it can end up in huge losses. All right, let's take one more example on this note. Let's talk about this post over here. It says that India Cements had reported a profit of 13 folds with a net profit at rupees 69.21 crore. And you can see, look at the date over here, it was posted on November 6th. Now, again, let's look at the charts of India Cements. We see that the earnings were posted on the 6th, but what has happened is the market beforehand started moving up. The results were out on the 6th, and what has happened is you can see the market made a high of 129 rupees. So, what the retail traders must have done is they must have long the stock over here, and the price started going on the upside. It made a high of 129. The retail traders were happy, but what has happened after that? Next day, immediately it gapped down, and from there the prices started falling down and made a low of 118, and thereby discouraging the retail traders. And many of the retail traders must have booked their losses over here. So that is why we should not trade on the news or any sorts of results or information that is out. All right. Now let's talk about why does the market not discount natural calamities. So there are two reasons for this. The first being a very basic and it's just basic common sense. It's nothing but, natural calamities in certain occasions cannot be predicted beforehand, and it occurs out of nowhere, and thus the markets are unable to discount this information prior. In the second scenario, let's talk about a little complex case over here. Let's say that there is a cyclone approaching a particular state. All right. Now, cyclone is such a natural calamity which can be predicted beforehand. The weather department or any other department which is related to this, what they will do is they will alert the people and they will say that there is a cyclone approaching the state. But still, the markets would not discount the information. And why is that? The reason being, there could be two potential outcomes of this cyclone approaching the state. The first being that the cyclone may never even hit the state and beforehand change its direction. Correct? In the second outcome, let's say that it is quite confirmed that the cyclone will hit the state, but still the markets won't discount this information. Why? Because the amount of damage that it will create in the area is something which is uncertain, right? Giving an example from the recent past, there was this news in the market that the cyclone named Nisarga is approaching Mumbai. Now, if you haven't heard of this news, please Google it up. Now, Mumbai being the financial capital, market should have panicked, correct? However, what has happened was the markets did not react to this news. And what happened with that cyclone? Nothing happened. There was a big hype created that the cyclone is approaching after a decade or so with very high speeds of about 130 kilometers to I think 150 kilometers per hour. And what had happened with the cyclone? It hit a very small area in Mumbai and it got eliminated. It did not create any damage in that area and nothing happened after that. That is why markets do not discount such sorts of information beforehand. All right. But what we need to understand over here from this point, there is a very fine line between the pre calamity stage and the post calamity stage. So, till now, we were talking about the pre calamity stage. Till the time the till the time the calamity did not hit a particular area. Now, let's talk about the post calamity stage. All right. Now, what has happened is let's continue with the example. Let's say that the cyclone hit the state and now it has created a certain amount of damage. Now, what the market will do is it will now factor in this information of damage into the markets and it will react to it. So, giving you an example from the recent past again is your COVID-19 situation. Now, this virus was in existence from around November 2019 or maybe December 2019. But what the Indian markets were doing is they were making fresh highs. And when the severity of this virus was determined, that is, when the government of India imposed a lockdown in the country and also the WHO announced this to be a pandemic, now the severity of this virus was determined and the damage that it will create to the economy was determined. What the market did was it immediately started falling. There was a huge plunge in the market, and the markets then reacted to this information. So, we need to understand this pre calamity stage. In the pre calamity stage, the markets will not react to the information. However, in the post calamity stage, if there is some sort of a damage or something which is affecting the economy or the stock markets, the markets participants will discount this information. So I hope you understood this point of what this principle means. The stock market discounts all information, and I hope you will be able to apply it on the stock markets. Now, if there is any questions on this, please feel free to WhatsApp us. My number is 730-397-0083, or we can also discuss it in our coming live doubt clearing sessions. All right. I hope you have a good day. Let's continue this module in the next episode. Bye bye.